Good morning, everybody. Thank you so much for joining SCB 10X REDeFiNE Tomorrow 2024. I'm Panich, CIO and CEO of SCB 10X. In this session, I'm very excited to welcome back Robert Leshner, CEO and co-founder of Superstate and founder of Compound. Robert has been speaker at our event every year since the beginning, and I have always interviewed Robert every year except last year, because last year our partner Bloomberg would like to interview Robert. And so I lost Robert for 1 year, but this year I got Robert back. Robert, you are famous for being the founder of Compound, the man behind DeFi Summer back in 2020, who kicked off all the craze of yield farming. Now you are back again as the co-founder and CEO of Superstate, solving quite different problem. Maybe could you please give the brief introduction about yourself and also about Superstate? What are the problem in traditional finance that you are trying to solve this time?
Yeah, absolutely. And I'm excited to, speak at this event again. It's a great annual tradition. So, starting in 2017, which is, 7 years ago now, I've really always been obsessed about how smart contracts and blockchains can make financial markets more efficient. Compound was, one of the first DeFi protocols. It was founded before DeFi was a phrase. But the idea was very simple. It was, can we use smart contracts to automate activity and to build a system that works in an open source, transparent, always on, extremely efficient way to do a function which was present off chain. And, as one of the first DeFi protocols, it really set the stage for so many other projects to be built. And, it was one of the first, frameworks to experiment with governance, and with a lot of things that today are extremely common. And one of the biggest things that I always envisioned when I was building Compound was that one day the assets that would be programmable and usable in Compound would be more than just the ERC20 tokens that existed when I, started work on it in 2017. And one of the things that, occurred over really 6 years was there was a growth of crypto native assets, assets that were issued for the first time in token launches. Almost 100% of the assets were specific to a crypto-based project. And all of the assets that are usable in DeFi today, that are tradable, that are borrowable, that are programmable, and that people use are really assets that are born first on blockchains. And in the past 7 years, we really haven't seen the growth of too many assets coming on chain that aren't crypto native in the first place. And for me, this is something that, I feel, society as a whole hasn't advanced far enough, because I think the real opportunity for DeFi protocols and why I've been so excited for this technology to exist and to be, developed over the last 7 years has really been to apply this technology to all of the world's assets, not just assets that are created and born on chain and are truly crypto native, but being able to use a DeFi protocol for crypto native assets as well as traditionally issued or created assets as well. And so Superstate is really my approach, and it's one of many approaches. There's a lot of different approaches that different companies and startups and protocols are taking to solve this, but it's an approach that I think has a good shot of working for bringing off-chain assets on-chain so that they can become composable and usable in DeFi protocols. And the long-term vision is really quite simple. I believe that in time, your Uniswaps, your compounds, your curves, your, MakerDAOs, the assets that are usable in them will just be all of the world's stocks, all of the world's bonds, all of the world's real estate, all of the world's commodities, not the 30 to 40 crypto native tokens that, have enough market cap to be relevant. And, Superstate is in some sense a bridging project. It's a project to bridge assets from off-chain to on-chain and build out the technology to do that. The technology is one piece. There's also the legal and regulatory considerations, which are much more complex than for most crypto native or crypto first projects. And the goal is to bring assets on chain so that they're composable with DeFi protocols. And that's really how Superstate was founded and, what I spend my time thinking about.
Mm, understood. I think your team wrote a blog about real asset that the value is 650 trillion US dollar, and that include off-chain real estate, stock, bond, and commodity. Why is it that right now is the right time for asset tokenization? Because I think we have seen quite some time about the attempt on many fronts. I think like in 2018, we've seen real estate tokenization with St. Regis Aspen, things like that. And over time, we've seen other type of asset. Winery got tokenized as well. And then in general, I think the only product market fit so far for the real asset that got tokenized is US dollar, right? Which is stable coin. Why is it that you think now it's time for other type of real asset to take off?
Yeah, that's a great question. So I think now is the right time for three reasons. And it's possible that we're still a couple years too early. I think a lot of people in the industry would have expected that, by now we would have, major real world assets that have been tokenized, and we're still at an infancy where there's very few success stories yet. But I think now is the right time for three reasons. The first is that the biggest adoption in my mind of the users or consumers or buyers of real world assets are not necessarily going to be retail. I think retail is most excited about crypto for the most volatile assets, the assets with the most upside, the most unpredictability. I think the buyers for the most part of real world assets, for the most part, are traditional market investors that are interacting both off-chain and on-chain. And the world increasingly is building the technical sophistication to interact with blockchains. And the number of investors that are moving from traditional markets to being able to handle traditional markets and crypto is growing every single month and every single year. And there's a big tailwind for a migration of investors that are able and interested in interacting with on-chain assets. And I think the primary, demand for RWAs is going to be somewhat institutional in nature. And, we're starting to see just broad signs that, institutional adoption is occurring in so many different ways. And so the first reason why I think now is because we're starting to see institutional interactions with crypto, and it's increasing constantly. Around the world, it's been happening more over the last couple of years. I think the US in the last, really this year since the approval of the Bitcoin ETFs has gotten really exciting.
Mm-hmm.
And so I think now is a great time just from institutions being ready to interact with RWAs. The second reason why I think RWAs are really exciting right now is the macro environment globally when it comes to rates. So stablecoins have, without question, been the first incredibly successful real world asset that has been tokenized. It's been a dollar or, a stablecoin backed by a dollar worth of assets. Stablecoins are successful. There's $160 billion of stablecoins. That's a lot of value. The problem with stablecoins is that they made a tremendous amount of sense when interest rates were low, because holding a stablecoin, you weren't really losing anything. With interest rates at 5.3% in the US, quite high across the globe in so many different economies, the opportunity cost of holding stablecoins has increased. And the macro environment, I think, creates a really interesting opportunity for people to look to alternatives to stablecoins. And RWAs are a complementary and competitive product to stablecoins, in that if you're already holding stablecoins, a tokenized real world asset that's equally stable-ish, that offers a higher return, is appealing. And, 3 years ago when interest rates were zero, there was no reason to hold an RWA, because stablecoins and RWAs would have been the exact same thing, and stablecoins were simpler. There was less complexity from a technical perspective, from a legal perspective, from a product perspective. Stablecoins made the idea of RWAs seem silly. But now, based on the sort of global rate environment, RWAs make a lot more sense than they did 2 years ago. And I think that's not going to change. There's going to be a non-zero interest rate, world for some time. I think we were stuck in a period of, zero interest rate, phenomena across the world. And it held down the demand for RWAs. And that's gone away. And I think we're going to continue to see this really interesting opportunity for assets with yield or with returns supplanting stablecoins over time. So that's the second reason why I think now's the right time. And lastly, I think now's the right time because I think we're entering an era of, people building tools that are intended to bridge, traditional financial markets and crypto markets. And I think the world in some senses is ready at this point. I don't think DeFi was mature enough 5 years ago, frankly, for handling billions of dollars of off-chain assets. I think the idea of, billions of dollars, being trusted to a DeFi protocol was somewhat crazy. And I think in a lot of cases, we've seen a maturity in the market over the last 5 years, which I expected, but very few people outside of crypto and DeFi expected, which is DeFi protocols have performed incredibly well in securing assets, in creating financial markets and financial products, and being safe and resilient in ways that I don't think most people outside of crypto could comprehend. And over the last 5 years, we've seen DeFi protocols survive across the board, survive and perform flawlessly when almost every single CeFi product or business collapsed over the last couple of years, including the largest ones like FTX and, Genesis and these companies that were considered, too big to fail in some sense in crypto. We've seen DeFi protocols survive. And I think we're really entering this moment globally where, people can start to believe in the idea of billions of dollars of off-chain assets running alongside and in and with on-chain systems. And I don't think that was possible 5 years ago. I think if you said, we're going to tokenize an asset and bring it on chain, people would very rightly say, why? You can't do anything with it on chain. There's no way we're going to interact with these protocols or these systems. That seems too risky or too crazy. And I think we're finally at the point now where DeFi has proven itself. And there's an opportunity to start to make use of the best of both worlds, the assets from off-chain and the systems that are on-chain. And so I think that's, one of the last reasons why the time is right. And it's possible, I said this before, we're still early. It's possible that, it's going to be another 3 years before we start to see major traction for Superstate, for other RWA platforms, et cetera. But I think now's the right time to start building on this actively.
Mhm. So let's talk about Superstate. The first product that Superstate offer is the Superstate Short Duration US Government Security Fund, which is pretty much tokenized treasury bill fund. And very curious, like how is it different from the traditional mutual fund? And also we saw the traditional mutual fund like BlackRock, Franklin Templeton, they also have now their own tokenized version of the T-bill fund. So how different are they from Superstate?
Yeah, that's a great question. So there's a couple ways that these products are different. Most of the differences are going to be relatively invisible to most users, where a lot of the differences are under the hood, not, above, the fold or in the product itself. At the end of the day, almost anyone creating, a short-term bond fund that holds, at least in the US, government T-bills, pretty much anyone's fund is going to have roughly the same returns and the same fees. Most managers are going to basically be able to create the same financial product, where if you look at them, just from a financial perspective or just from a fee perspective, they're going to look very similar. It doesn't matter whether it's off-chain, doesn't matter whether it's on-chain. The financial product is going to be very similar. What's going to be different is how it's created, who it's offered to, and what you can do with it once you're an investor. And I think that's where we start to see differences. Superstate's first fund is a T-bill fund, just like tons of them that exist. The difference is, to traditional funds is that it's tokenized. Your ownership of it is recorded as an ERC20 token on Ethereum, as opposed to that ownership being recorded by a series of intermediaries and middlemen, running pretty much just on databases and spreadsheets with tons of different ledgers and tons of different records. It's a token that's the record keeping system of ownership. That's really how most tokenization in general works, is that, instead of using, a whole heap of complex back office processes to record who owns an asset, tokenization in general is just using a token to record ownership. And this makes a lot of sense because one of the things that anyone who works in crypto or invests in crypto can appreciate is that one of the best features of crypto assets is the simplicity of tracking ownership. A token is ownership. You can program it. It settles basically instantly. It's 100% transparent, and there's no questions about who owns the asset. Satoshi solved this with the double spend problem. The whole beauty of crypto assets in general is that it's very obvious who owns it. And so it's just a wonderful way to record ownership. And that's the first way that Superstate's products differ from traditional funds, even though they might invest in the same assets, have the same fees and the same returns. The second way it's different to other sort of tokenized products are a little bit more, subtle. So the way it's different from BlackRock's fund is there's legal differences. It's domiciled as a standalone bankruptcy remote trust in the US versus being an offshore fund. There's like peculiarities like that I honestly don't think most investors dive that deep into the details of anyway. Where it differs is that, we really expect that over time, our focus is going to be on, integrating the asset with DeFi protocols and building out a, system where ownership can be tracked, compliance can be maintained, but the asset is still usable in really interesting ways on chain. And I think that's where we're going to start to see over time a pretty big fork in the road.
Got it. So right now for Superstate, your assets are in the trust bankruptcy remote, but for the BlackRock and Franklin Templeton, they are not. Is that correct?
Yeah. So Franklin Templeton is a similar structure, I believe, in that it's a standalone entity, whereas BlackRock is, I believe, just an offshore fund.
Got it. Okay. And Robert, I'm very curious about record keeping too, because I think we are dealing with two ledgers, right? One in physical world and another is in digital world. So we have two versions of truth. And from what I understand right now is that the physical one is the main one. Will we see the scenario that over time this will transition into the digital or the blockchain version be the main ledger in the future or the only ledger in the future?
This is a great question. So, we have two different funds that we've designed. The first is, we're trying to create over time, a registered fund in the US in which, the structure of it that we propose is that there would be two sources of truth. One would be, a traditional books and records, and the second would be a token. That fund is a draft. It's not a live product yet. The product that we have that is a live product, there's one source of record, which is the token. This fund is only offered to qualified purchasers, so it's not available to the whole world. It's not available to the investing public at all. It's only available to a subset of, extremely, high asset institutional investors. But our hope is over time to go through the regulatory process in the US and have a fund that's a registered fund that anybody can invest in. And when we do that, it's going to have, a legal structure and a regulatory structure that works with the US structure. And, right now, there's yet to be a product approved by regulators in the US where the token is the only source of truth. Because a lot of the rules have been written and a lot of the oversight and a lot of the processes that exist are designed for traditional financial vehicles that are run off back offices with lots of different paper and spreadsheet records, not with, a token being the only source of truth. And so we're really excited for this to change and be one of the pioneers of this and work towards this idea that you can have, public regulated assets that are just a token. I think it's one of these like very long-term shifts that's going to occur for Superstate, for 100 other funds, for 100 other products, for 100 other tokens. But it's at a very early point when it
Mhm.
comes to the implementation of this.
And Robert, what do you think about transfer agent? Can we have on-chain transfer agent in the future? Because right now, transfer agent is like the middleman, right? That do the record keeping of like who owns what in the fund. And that is something that I think can be on-chain. And I think I read that some people create transfer agent protocol that use for minting cap table automatically, things like that. Yeah, is that something that can happen in the future?
Absolutely. I mean, I think you understand this, very well, which is, in the US, and this is very different in foreign jurisdictions. There's, every country has its own approach to this. I'll speak just to the US. Right now for a publicly registered and traded fund or asset, there has to be a traditionally registered transfer agent. And, you know, people working crypto say, well, the blockchain is the best transfer agent. Every time you transfer a token, it records the ownership and updates it. And, you know, why can't just the token be, the record? And I think these two things will reconcile over time. I think, we'll get to the point where people say, yeah, of course, just a token is all the record keeping you need because, legislators and regulators understand how a token works. We'll get there. For sure we will. I think in the interim period, what we're going to see is this hybrid where there has to be, transfer agents and these traditionally registered intermediaries, but they start to use tokens and use on-chain systems to inform their traditional record-keeping approach.
Mm, I see. In terms of competition, let's go back and talk a little bit more on that. So we have seen the market for tokenized T-bill fund, tokenized US Treasury has gone up 10 times from last year. At the beginning of last year, it was only $100 million, and now it's 1.3 billion from last I checked. And of course, thanks to Superstate and Franklin Templeton, BlackRock, and others. Yeah, curious about what do you think about other competitors that are more crypto native, like Ondo Finance, Open Eden, things like that? Yeah, what do they do that are different from what Superstate is doing?
Yeah. So every, company that's building RWA products has a slightly different approach. Some have a focus more on international investors. Some have a focus, more on, partnerships. Some have a focus more on building technology. One of the things that makes Superstate unique, and I don't think there's any product on the market like this today, is that Superstate is both the asset manager in that we are an investment manager that's purchasing assets and creating a fund. And we're also a technology platform that's turning that fund into a token. And that's sort of the, end-to-end process and business that Superstate has created. And the other tokens out there, for the most part, are doing like one or both of these, in that, they might, have a tokenization process, but they're using other people's funds or
Mhm.
investment management and sort of wrapping them, just like, Ether gets wrapped as wrapped Ether. A lot of products are just wrapping some other investment asset. Whereas Superstate is creating a fund that's a token because we're both an asset manager and a technology business. There's some products that are, building just a technology piece of this. Securitize is a great example of this. And
Mhm.
so, everyone has a slightly different approach. And, I think for the industry as a whole, it's still extremely early. I hear a billion, 1.2 billion, whatever it is. That's a drop in the ocean right now, right? And I think it's so early that, it's hard to even begin to say what's going to work. And I'll say that even about Superstate. It's very early. Um, it's like looking at DeFi when it was $1 billion and say, well, what's going to work? Or looking at, stable coins when there was just $1 billion of stable coins and say, well, what's going to work? I think we're at the same point right now where the total market size is 1 billion. If you look at, whether it's stable coins or whether it's DeFi, they all started at 1 billion as well. And now they're all 100 billion. When you look at the growth of any asset class, they all start at a small number and grow to be a really big number. And along the way, there's tremendous changes in terms of what works, what doesn't work, how it works, who's doing what, how they're doing it. There's, M&A, there's failures, there's, new competitors constantly. in a lot of ways, we're at the very beginning of this. And so I think, the questions about competition are really interesting, but I think that, every one of these companies, Superstate and anything that's even considered a competitor, are all going to be evolving dramatically over the next couple of years.
Mm, yeah. I think one thing that can very much differentiate tokenized fund is the composability, right? When do you think that we can see more composability of tokenized T-bill be able to use in DeFi a lot more?
Yeah, I think soon. The reality is, I think one of the bigger mismatches is that the investors in, right now, the current investors in these products are mostly buy and hold investors. And they're mostly more institutionally inclined than retail is. They're less likely to be using DeFi protocols directly. And so, I think that's going to change. I think over time there's going to be much more composability between RWAs and DeFi protocols as the market grows and as the users grow from being institutions. But right now, at least from Superstate's perspective, most of the people buying Superstate tokens today are buying them as an asset because they can hold it in the same custodian they hold their Bitcoin and their Ether and their DeFi tokens in. They can hold T-bills wrapped in a tokenized fund in the same place using the same systems, using the same you know, processes, using the same wallets. And that's why they're investing. They're not taking assets out of custody to interact with DeFi protocols yet. As the market for RWAs grows from a billion to 10 billion, or even, a billion to a couple billion, I think we're going to start to see a lot more composability with DeFi as we get from beyond this like very first customer group that's the first early adopters of RWAs.
Mhm. How about in terms of legal and regulation? What are the challenges that you face, and what do you think are preventing a lot of real world assets to come in to be tokenized because of legal and regulation? And is there any way that we could solve this?
Yeah, this is one of the biggest opportunities and difficulties right now in RWAs is that every single country, for the most part, has its own legal and regulatory frameworks for assets to be issued, traded, owned across the world. And so this question is much more complicated than just like, one country. Assets exist under a lot of different jurisdictions. In the US over the last couple of years, there's been essentially a paralysis in the legislative and regulatory process. And I think this is, in a very good way, rapidly changing and evolving. And I think we're starting to exit this paralysis as the government in the US, sees that there's widespread support for crypto legislation and regulation. But there's been a total paralysis. And one of the reasons why we haven't seen more RWA traction or creation or adoption is because, the legal regime that they find themselves in is so complicated. It's almost like the worst of all worlds. It's like, if you're a bond fund, you have all the regulation of like a bond fund, but also of crypto. And also all the intermediaries that would want to interact with it don't know what it is because there's very little, legal basis for it. And no one that knows how these things are supposed to work. And it's a gray area for the most part. And so, you know, in a lot of ways, the legal and regulatory environment has been a total headwind because there's no clarity and there's been no progress at all in years in the US. And so that's starting to change, and I'm incredibly optimistic because there's a lot of really good signs starting to emerge. But right now, that is the biggest challenge for building a product based in the US.
Mm. How about what are other sweet spot assets that the Superstate will tokenize next?
It's a great question. I mean, I think, a very low risk yielding asset makes the most sense. But I think over the next couple of years, there's no reason why we're not going to start to see tokenized equity index funds, whether it's the S&P 500 or the NASDAQ or global indices. I think there's going to start to be, tokenized, real estate or commodity indices. I think there's a lot of like core asset building blocks that just don't exist on chain yet that are composable with DeFi protocols. And I think over the next couple of years, the number one thing that will occur, just like very, asset class, building block assets as being the things that come on chain, as opposed to like niche or esoteric assets.
Mm. What advice do you have for traditional finance firms that are interested in exploring real world asset? What should they do?
Well, I would say the first thing you should do if you're interested in real world assets, you know, check out Superstate's products, follow me on Twitter or Leshner. But more than anything, just, read CoinDesk and The Block and, all the publications in the industry and get curious about it and just, you know, see what's happening and see what's being built. It's a very small industry, just like in a lot of ways, DeFi was extremely small in 2018, where there's a couple projects. RWAs feels like that in 2024, where there's a couple projects. It's still incredibly small. And so there's not that much you're going to have to study. If you're interested in this stuff, dive head first.
Okay, all right. Yeah, I think that's pretty much time that we have. I have so many more questions to ask you, Robert, but I think that will have to be another time. Yeah, thank you so much for joining us again and really
Thanks,
appreciate
Kai.
it. Okay,
Really appreciate it.
yep, bye.